Hey guys, welcome back to the Bitcoin Fortress podcast. It is Sunday, June 28th, 2026. We are recording at block height 955830. Moscow time is 1680, meaning $1 now buys about 1,680 satoshis. And fees are beautifully quiet at 1 and 2 sats per VByte. That right there is always worth pausing on. While the financial world argues over stablecoin regulation, treasury market plumbing, Fed balance sheet language, ETF outflows, Iran sanctions, and whether Bitcoin is dead again, the network is doing what it always does. Blocks keep coming. Settlement remains open. Finality remains available. The fee market is calm. Nobody asked permission. Nobody had to convene a committee. This week has a very specific feeling to it. Bitcoin is weak in price terms. Sentiment is rough. The ETF bid is not saving the day. Strategy is under pressure. The 4-year cycle debate is back. At the same time, the old monetary order is showing stress everywhere. Stablecoins are now important enough that community banks are fighting them. The Bank of England is trying to contain them. The BIS is warning that they are not real money. And the U.S. appears to be using dollar access itself as a geopolitical bargaining chip with Iran. So the theme this week is simple: price weakness in Bitcoin, structural weakness in fiat. Those are not the same thing. Bitcoin can fall in dollar terms while the dollar system itself becomes more fragile, more politicized, more surveilled, and more dependent on intervention. That is the paradox we need to hold in our heads. And so with that, let's get into it. With the news of the week. First category, we'll talk about Bitcoin price, sentiment, and the treasury trade. The lead market story this week is obvious. Bitcoin traded below the $60,000 area again, and that has shifted the emotional tone of the market. The mainstream framing is predictable. Bitcoin has had a terrible 2026. It is down heavily from the 2025 highs. ETF flows have reversed. Retail is bored. AI stocks are more exciting. Gold is shinier. The institutions supposedly came, and now they're leaving. But I think Bitcoiners should be careful here. The fact that price is weak does not mean the thesis is weak. It means the market is repricing liquidity, leverage, and expectations. This is where Bitcoin humbles everyone. When price is going up, everybody says they're long term. When price falls 40 or 50%, suddenly everyone becomes a macro trader. But the network does not care. The issuance schedule does not care. The private keys do not care. The key question is not, is Bitcoin down? The key question is, has anything about the monetary thesis changed? And I would argue the answer is no. If anything, the events of the last month strengthen the thesis. The U.S. is openly using sanctions relief and dollar access as geopolitical tools. Central banks are trying to redesign money around tokenized deposits and wholesale CBDCs. Stablecoins are becoming a battleground between banks, regulators, and crypto firms. Governments are still running massive deficits. The Fed is still managing the plumbing. Bitcoin is weak because markets are weak, but Bitcoin exists because the monetary system is weak. That distinction matters. The second big story is ETF outflows. U.S. spot Bitcoin ETFs reportedly saw roughly $1.79 billion in weekly net outflows during the week ending June 26. This matters because the ETF complex has become the visible marginal buyer for Bitcoin in this cycle. For a while, the story was simple. Wall Street opened the pipe, money flowed in, and price went up. Now we are seeing the reverse. When the pipe goes negative, price can get heavy very quickly. But here's the deeper point. ETFs are not Bitcoin adoption in the strongest sense. They are price exposure. They are paper wrapper adoption. They matter, but they are not the same as people taking self-custody, running nodes, using Bitcoin as savings, or building Bitcoin-denominated balance sheets. ETF outflows tell us something about investor positioning. They do not tell us whether Bitcoin is working. In fact, this is probably a healthy reset. The ETF buyer is often performance sensitive. If Bitcoin underperforms AI stocks, gold, or high-yielding cash, the ETF holder may leave. The self-custody holder is different. The treasury holder is different. The person who understands why Bitcoin matters is different. So yes, ETF outflows are a headwind, but they also separate tourists from citizens. Michael Saylor posted another more charts style tease this weekend, suggesting strategy may be preparing another Bitcoin purchase, even as the stock remains under pressure. This is one of the most important stories in Bitcoin right now because strategy has become more than a company. It is now a live experiment in Bitcoin corporate finance. There are two ways to look at it. The bullish view is that Saylor is building the first true Bitcoin capital markets machine. He uses equity, preferreds, convertibles, and market volatility to accumulate more Bitcoin per share over time. If Bitcoin monetizes long term, strategy becomes one of the most important financial companies in the world. The skeptical view is that the structure becomes harder to manage in a prolonged drawdown. Preferred dividends are real. Market confidence matters. Access to capital matters. Premium to NAV matters. And if Bitcoin trades below strategy's average cost for long enough, the market starts asking uncomfortable questions. My view, this is not a simple story. Saylor might be right on the long-term monetary thesis and still face painful capital market constraints in the short to medium term. For Bitcoiners, the lesson is important. Bitcoin itself has no debt, no preferred dividend, no board, no refinancing wall, no quarterly earnings call, and no need to persuade anyone. Bitcoin treasury companies do. That does not make them bad, it just means they are not Bitcoin. They are leveraged human institutions built around Bitcoin. Several outlets this week focused on the risks of Strategy's Bitcoin bet and who ultimately bears the pain if the trade goes wrong. This is useful because the market is finally distinguishing between Bitcoin the asset and Bitcoin-linked financial engineering. That is healthy. In the bull phase, everything gets lumped together. Bitcoin miners, exchanges, treasury companies, ETFs, preferred stocks, crypto equities. In the bear phase, the market starts separating balance sheets, liabilities, governance, and cash flows. A Bitcoin treasury company is not just Bitcoin with a ticker. It has management risk, financing risk, dilution risk, market structure risk, and sometimes regulatory risk. This is why the best Bitcoiners always return to first principles. Not your keys, not your coins. Equity exposure can be useful, ETFs can be useful, preferred shares can be useful, but they are all claims inside the fiat financial system. Bitcoin in cold storage is a bearer asset outside that system. That difference becomes more obvious when markets get stressed. 21 Shares released commentary saying that Bitcoin's 4-year cycle has not disappeared even though the structure of the market has changed. This is fascinating because a lot of people believed the ETF era would break the cycle. The argument was that institutional adoption would smooth out volatility. Bitcoin would become more mature. Drawdowns would be less violent. The halving cycle would matter less. But here we are again. Price ran hard, sentiment got euphoric, leverage built up, and now the market is cleaning itself out. My take is that the 4-year cycle is not just about the halving, it's about human psychology layered on top of program scarcity. The halving changes the supply schedule, but people still chase momentum. They still over-leverage, they still extrapolate, they still panic. The ETF may change the plumbing, but it does not repeal human nature. That is why Bitcoin remains such a brutal teacher. It rewards low time preference, but it punishes emotional leverage. Next category, stablecoins, banking, CBDCs, and the fight over digital dollars. One of the biggest policy stories this week came from the community banking world. More than 4,000 local U.S. lenders, represented by the Independent Community Bankers of America, are pushing back against stablecoin legislation. Their concern is simple. If stablecoin issuers can offer rewards or incentives, deposits may leave small banks and flow into digital dollar platforms. The banks warn this could drain deposits from local lenders and reduce credit availability for small businesses and farmers. This is a major signal. Stablecoins are no longer a crypto side project. They are now a direct competitor to bank deposits. For Bitcoiners, the key insight is that the dollar system is being rebuilt in real time. Stablecoins are not anti-dollar. They are offshore, programmable, privately issued dollar instruments. In some ways, they extend dollar hegemony. In other ways, they weaken the traditional banking model. That is why the politics are complicated. Wall Street may like stablecoins. Crypto firms like stablecoins. Treasury may like stablecoins because they create demand for T-bills. But community banks see them as deposit flight machines. This is not a small fight. This is a fight over who gets to issue money-like liabilities in the digital age. The OCC issued a proposed rule to implement Bank Secrecy Act and sanctions compliance standards for OCC-supervised permitted payment stablecoin issuers under the Genius Act. This sounds boring, but it is extremely important. The compliance layer is where the future of digital money gets shaped. The question is not only can stablecoins exist, the question is under what surveillance, identity sanctions, and reporting framework will they exist? This is where Bitcoiners need to be very clear. Stablecoins are useful. They're powerful. They may help people in weak currency countries. They may improve payments. They may strengthen demand for U.S. Treasuries. But they are not freedom money. They are regulated dollar liabilities. They can be frozen. They can be surveilled. They can be permissioned. They can become programmable compliance rails. Bitcoin is different. Bitcoin is not a digital dollar. Bitcoin is not a fintech upgrade. Bitcoin is monetary exit. That distinction should be central to all of us. The American Prospect reported that crypto firms are getting much of what they wanted in Genius Act implementation, especially compared with the banking lobby. This is interesting because it shows that the crypto industry has matured politically. We are no longer in the era where crypto is just begging regulators not to destroy it. The industry now has lobbyists, donors, trade groups, and legislative influence. That may be good for adoption, but Bitcoiners should remain skeptical. Regulatory clarity is not the same as freedom. In some cases, regulatory clarity means the state has figured out how to absorb the industry into the existing system. This is the danger of crypto wins. The win may be that stablecoin issuers become regulated extensions of the treasury market. Exchanges become compliance gateways. Tokenization becomes Wall Street plumbing, and Bitcoin gets treated as a pristine collateral asset inside a system that still wants control. That is not necessarily bad for price. It may be very bullish for price. But Bitcoin was not created merely to become another asset inside the compliance machine. The Bank of England released a revised stablecoin framework. It dropped proposed individual holding caps and instead moved toward a £40 billion issuance limit per stablecoin while allowing more reserves to be held in short-term government debt. This is another major signal. The UK wants stablecoin innovation, but only inside a tightly managed framework. They want payment innovation without losing monetary control. They want competition without bank runs. They want digital money without surrendering the hierarchy. The important point for Bitcoiners is that every major jurisdiction is trying to domesticate digital money. The U.S. approach is likely to favor dollar stablecoins and treasury demand. The UK approach is cautious and bank protective. The EU has MiCA. The BIS wants tokenized deposits and central bank money at the core. Everyone wants the technology, nobody wants the exit. Bitcoin is the exit. The Bank for International Settlements released commentary saying stablecoins show some promise for programmable payments, but falls short on key properties of money and may pose financial stability risks. This is the central bank view in one sentence. Stablecoins are useful technology, but unsound money unless subordinated to the banking system and central bank balance sheets. The BIS wants a tokenized future, but not a decentralized one. It wants unified ledgers, tokenized deposits, wholesale CBDCs, and central bank settlement assets. That is the preferred architecture of the official sector. From a Bitcoin perspective, this is incredibly clarifying. The future they want is not paper money versus digital money. It is controlled digital money versus uncontrolled digital money. The official sector is not afraid of tokens. It's afraid of monetary instruments it cannot control. And that is why Bitcoin matters. The Anti-CBDC Surveillance State Act remains pending in the Senate after passing the House in 2025. The bill would restrict the Federal Reserve from issuing or developing a retail CBDC without congressional authorization. This matters even if you think a U.S. retail CBDC is politically unlikely. The deeper issue is precedent. Can the central bank create direct digital money accounts for citizens? Can programmable money be used for monetary policy? Can payments become fully surveilled by default? Can financial access become conditional? These are not paranoid questions anymore. They are design questions. Bitcoiners should support strong barriers against retail CBDCs, but we should also recognize that CBDC-style control can arrive through private rails too. A fully regulated stablecoin ecosystem with mandatory identity, blacklist compliance, and programmable restrictions could replicate many of the same concerns. The threat is not only CBDC, the threat is permissioned money. All right, moving along to macro, liquidity, dollar power, and geopolitics. Reuters reported that a New York Fed official downplayed new FOMC language about buying Treasury bills and short-term securities when necessary to maintain ample reserves. This is the kind of plumbing story that Bitcoiners should pay attention to. The Fed does not have to announce QE for liquidity management to matter. Sometimes the real action is in implementation notes, reserve management, bill purchases, repo facilities, and balance sheet operations. The official line is that it's technical, and maybe it is, but the pattern is bigger. The Treasury market is now so large, so central, and so fragile that the Fed has to remain deeply involved in keeping the machine functioning. That is the architecture of modern fiat. Markets appear private until liquidity breaks, and then the central bank becomes the dealer of last resort. Bitcoin is the opposite. It does not require an ample reserves regime. It does not need a standing facility. It does not need a primary dealer network. It does not need a central bank to clarify implementation notes. Bitcoin is monetary settlement without a committee. CF Benchmarks noted that Bitcoin implied volatility held relatively steady, even as hawkish Fed signals, a stronger dollar, and rising front-end yields pressured risk assets. That is interesting. Bitcoin price is weak, but volatility is not exploding the way you might expect. This may indicate that the market is stressed, but not panicked. It may also mean a lot of leverage has already been cleared, or it may mean that options markets are not pricing a catastrophic break despite ugly spot action. The bigger point is that Bitcoin is trading like a macro asset right now. It is sensitive to real rates, the dollar, liquidity, and risk appetite. Some Bitcoiners do not like hearing that, but it is true in the short run. Bitcoin is long duration monetary insurance. When real rates rise and the dollar strengthens, that insurance can mark down. But long term, the reason to own Bitcoin is that the system cannot tolerate high real rates forever. Debt levels are too high. Political incentives are too strong. The end game remains repression, intervention, and debasement. The Wall Street Journal reported that the U.S. has allowed Iran to sell oil in dollars under a temporary sanctions waiver tied to broader diplomatic negotiations. This is one of the most consequential stories of the week. For decades, dollar access has been one of America's most powerful geopolitical weapons. To allow Iran back into dollar oil settlement, even temporarily, is not just a sanctions story, it is a monetary power story. This gets directly to the question that I've been thinking about a lot, which is, was the U.S. Iran episode a Suez-style moment? Maybe, time will tell. But what we can say is that the monetary order is becoming more visibly transactional. Dollar access is granted, revoked, waived, negotiated, and weaponized. That is powerful in the short run, but in the long run, every use of the dollar as a political weapon teaches the rest of the world to look for alternatives. Gold benefits from that. Bitcoin benefits from that. Neutral settlement assets benefit from that. The dollar remains dominant, but dominance is not the same as permanence. Gold and silver are still reacting to the same macro cocktail: Iran risk, oil prices, the dollar, Fed expectations, and U.S. jobs data. This is relevant because gold and Bitcoin are increasingly part of the same conversation. Neutral reserve assets in a world where fiat credibility is weakening. Gold is the old world answer. Bitcoin is the new world answer. Gold has no counterparty risk, but it's hard to move, hard to verify at scale, and historically easy to capture into vaulting systems. Bitcoin is volatile, young, and politically misunderstood, but it is globally portable, auditable, divisible, and self-custodiable. I do not think Bitcoiners need to attack gold. The better framing is that gold is confirming the same monetary diagnosis. Central banks are buying gold because they know the system is changing. Individuals buy Bitcoin because they want the same neutrality in a digital portable form. The signal is not gold versus Bitcoin. The signal is neutral money versus political money. Next up, mining, energy, and infrastructure. TechRadar reported that AIONX is spending around $500 million to acquire control of former Genesis Digital Assets mining sites and repurpose them toward AI and high-performance computing infrastructure. This is a major infrastructure story. Bitcoin mining and AI compute are now competing for the same scarce resource: power. Not GPUs, not software talent, power. This tells us something important about the next decade. Energy is becoming the base layer of the digital economy. Bitcoin miners discovered stranded and underutilized power. AI companies now want that same power. Data center operators want the grid connections, substations, land, and energy contracts that miners built or secured. For Bitcoin miners, this creates both risk and opportunity. The risk is that AI compute may outbid mining for certain sites because AI customers can sign long-term contracts at higher margins. The opportunity is that miners with power assets may become more valuable, even if mining margins are weak. For Bitcoiners, the bigger point is that proof of work tied Bitcoin to the real world. Bitcoin is not just code floating in cyberspace. It is code anchored in energy, infrastructure, and capital discipline. That is one reason it is so hard to copy. Moving right along to the Bitcoin podcast universe themes of the week. There were 5 themes circling around this week. Theme 1, who is selling the Bitcoin? Natalie Brunell's Coin Stories episode with Preston Pish focused on bearish sentiment, who is selling Bitcoin, strategy warning signs, and the broader question of what is actually fragile in this market. That is probably the key emotional theme of the week. When Bitcoin is falling, everyone wants to know who the forced seller is. ETFs, retail, treasury companies, miners, leveraged traders. The answer is usually all of the above, but in waves. The better question is, who is buying with conviction? Bear markets transfer coins from leveraged hands to patient hands. That is the whole game. Theme 2, Bitcoin treasury companies are not Bitcoin. The strategy debate showed up across several podcasts and market conversations this week. The distinction is becoming clearer. Bitcoin is pristine collateral. Bitcoin treasury companies are financial structures built around pristine collateral. That is not an insult. It is just a category distinction. The market is asking whether these companies can survive prolonged drawdowns, maintain access to capital, and avoid becoming forced sellers. That conversation is healthy. Bitcoin does not need heroes. It needs verification. Theme 3, stablecoins are becoming statecraft. Nick Bhatia's recent discussion on what Bitcoin did about Bitcoin, stablecoins, the Eurodollar system, and stablecoins as statecraft fits perfectly into this week's news. Stablecoins are no longer just crypto casino chips, they are becoming a geopolitical dollar rail. The U.S. may use stablecoins to extend dollar demand abroad. Treasury may like the T-bill demand. Emerging market users may like dollar access. Crypto firms may like the business model. But Bitcoiners should keep the hierarchy clear. Stablecoins are useful dollar tools. Bitcoin is the escape hatch. Theme 4, the macro crowd is converging on the same diagnosis. The Kitco conversations with guests like Lawrence Lepard and David Wu are not Bitcoin-only shows, but they are very relevant to Bitcoiners. The recurring themes are debt spirals, gold strength, dollar fragility, geopolitical realignment, and eventual monetary repression. That is the macro backdrop for Bitcoin. Even when these guests are more gold-focused, the diagnosis is similar. The fiscal math does not work, the dollar system is under pressure, and savers need neutral assets. And finally, theme 5. Digital money is splitting into two paths. The stablecoin solutions discussion and broader podcast conversations this week all point to the same fork in the road. One path is regulated digital dollars, stablecoins, tokenized deposits, compliance rails, bank partnerships, treasury backing, and programmable payments. The other path is Bitcoin, fixed supply, self-custody, censorship resistance, no issuer, no central bank, no compliance department at the protocol layer. Both paths will grow, but they are not the same path. This week's featured Substack is week 6 of A Bitcoin Way of Life. The heart of this series is that Bitcoin is not just an asset allocation, it is a way of seeing the world. It teaches patience, it teaches personal responsibility, it teaches independence from broken institutions. It teaches you to lower your time preference and to think in decades instead of quarters. It teaches you that hope is not the same as optimism. Optimism says everything will be fine. Hope says the world may be broken, but we can still build something better. That's why I keep coming back to the phrase, Bitcoin is hope. Not because price always goes up, not because Bitcoin fixes every human problem, but because Bitcoin gives ordinary people a way to step outside a system that constantly dilutes their savings, distorts their incentives, and asks them to trust people who have not earned that trust. A Bitcoin way of life is not about staring at charts all day. It's about becoming the kind of person who can hold truth through volatility. And in a week like this, that matters. Before we head toward the close, I want to mention my 4 Bitcoin Fortress books. These books are part of the same broader project as this podcast and the Substack, building a Bitcoin-centered framework for understanding money, sovereignty, and the world we're moving into. The newest book is The Architecture of Money, which came out of the long-form macro series we built earlier this year. That book is about the structure underneath the monetary system, debt, central banking, inflation, political incentives, debasement, and why Bitcoin represents a fundamentally different architecture. If the podcast is the weekly signal and the Substack is the deeper written reflection, the books are the permanent record. So please check out the Bitcoin Fortress books, especially the new one, The Architecture of Money. Links in the show notes to those as well as everything we've covered here today. Well, folks, that's episode 222 of the Bitcoin Fortress podcast. It was a heavy week. Bitcoin is weak. Sentiment is ugly. ETF flows are negative. Strategy is under pressure. And yet, When you zoom out, the case for Bitcoin is not weaker, it's stronger. The fiat system is becoming more managed, more politicized, more surveilled, and more unstable. Stablecoins, ironically called stablecoins, are challenging banks. Central banks are trying to redesign money. The Fed is still managing treasury market plumbing. Dollar access is being negotiated as a geopolitical weapon. Gold is confirming the neutral money thesis, and Bitcoin keeps producing blocks. So, do not confuse price with truth. Bitcoin is volatile because it's free. Fiat is stable because it is managed, but managed systems can hide risk for only for so long. At block height 955830 with fees 1 and 2 sats per VByte, the network is still here, quiet, open, global, unbothered. Stack sats, stay humble, protect your keys, think long term. This is the Bitcoin Fortress podcast, and I will see you all next week. Bye bye.